Imagine turning a small trading account into tens of millions of dollars with such clinical machine-like precision that you average 220% returns every single year for 5 years straight. We aren't talking about a math genius from MIT with a supercomputer. We are talking about a guy who left high school in the 8th grade, a guy who started with nothing but a burning desire to break free from financial struggle. This is the story of Mark Minervini, the man who achieved what most consider mathematically impossible, turning a tiny stake into a fortune with a total return of 33,500%. That number sounds like a typo, like some offshore crypto scam, but it's a verified, audited reality. Most traders spend their entire lives looking for a holy grail, a secret indicator, or a magic crystal ball. Minervini found something much more powerful, a repeatable, systematic pattern that identifies exactly when a stock is about to enter its most explosive phase. Breaking the buy low myth. If you've ever felt like the market is a rigged game where you're always the last one to the party, buying the top and selling the bottom, it's probably because you're following the common sense advice that actually keeps the majority of retail traders broke. We are conditioned to look for bargains. We are told to buy low and sell high. We search for stocks that are cheap or undervalued. Minervini did the exact opposite. He became one of the most successful traders in history by buying stocks that were already expensive and selling them at prices that seemed insane. He calls his approach SEPA, specific entry point analysis, and the crown jewel of that system is a single chart setup known as the volatility contraction pattern, or VCP.
This is Khalaf Alonzi from Stocks and Stories 2 YouTube educational channel, and I'm going to cover VCP components in a nutshell. We know that Mark Minervini trades VCP pattern. If you don't know who is Mark Minervini or what is the hell of VCP, please check out my educational, informational video about VCP and Mark Minervini story in the comments section, as well as in the description box. So let's get back to our video. The VCP pattern consists of 4 main categories. So in order to master the VCP trading strategy, we have to master all of these 4 components. The first one is SEPA system, specific entry point, what to trade and when to trade it. The second thing is the trend template, what to look for in a stock technically in terms of technical indicators and its price, where is it from the 52-week high and the 52-week low, etc. The third point is the growth focus, what to look for in a stock fundamentally. You're not gonna have to go over the sheets or financial sheets of the company, but it will give you what to look for in general in terms of sales, growth, and sales margin, profit margins, and so on. The fourth component of VCP is the risk management. When and where to sell, where to place a stop loss. This is very important for you, because if you do not know how to risk manage your portfolio, you will never be able to earn money or make money, not even in any other trading setup, not only with the VCP. So this part of the VCP components will deal with how to trade, how much you should buy from your portfolio, when to sell it, where to sell it, etc. In this video, I'm going to cover.
But before you can even look at a chart, you have to understand the environment where these moves happen. Minervini doesn't just trade any stock that looks good. He waits for the wind to be at his back. This starts with a fundamental understanding of stage analysis. The VCP setup. Every stock on the market exists in one of 4 stages. Stage 1 is the neglect phase. This is where the stock is just moving sideways, building a foundation, but ultimately doing nothing. Stage 3 is the top. stop where the smart money is quietly exiting while the public is finally getting excited. Stage 4 is the decline, the bloodbath phase, where most retail investors lose everything trying to average down on a dying company. Minervini only cares about stage 2, the advancing phase. Statistical data shows that 95% of the biggest market gainers in history made the absolute bulk of their profits while in a stage 2 uptrend. If a stock isn't in stage 2, it doesn't exist. You are looking for a momentum train that has already left the station and is picking up speed. This brings us to the meat of the strategy, the VCP pattern itself. Think of a stock that has already had a massive high energy run higher. Most people see that run and think they've missed the boat, but Minervini is watching for a very specific type of pause. Instead of crashing back down after that run, the stock starts to move sideways. As the stock consolidates, the way it tightens is what matters most. Instead of moving randomly, the price begins to contract. The first pullback might be sharp, around 25% from the peak. The next drop is smaller, maybe 12 to 15%, and the third becomes even tighter, around 5%. Each pullback shrinks, creating a clear pattern of decreasing volatility. This tightening action is the edge. It's like a spring being compressed more and more with each move. At the same time, trading volume begins to fade, signaling that sellers are drying up. The weak hands have already exited, leaving behind stronger investors who are holding firm. With supply nearly gone, even a small wave of demand can trigger a powerful move. This final tight range is called the pivot point, the launch zone. When price breaks above it with a strong surge in volume, it confirms institutional buying and often marks the start of a major upward move.
With the price cycle and VCPs, context, because it's where are you seeing specific things. So let's just start off the 4 stages of the price cycle. Stage 1, neglect phase. So that's going to be consolidation down here. There's actually a really nice VCP that you're going to see in a couple of slides time down here as well. I'll give you a clue. 1 contraction, 2 contraction, 3 contraction. You could also include this as well. Stage 2 is the advancing stage. So that's going to be here where you see a nice uptrend in the stock and all the general indexes as well. Stage 3 is the topping phase where you have distribution coming through in here. Stage 4 is the declining phase. So that is when there would be a downtrend. So you are looking for the market to be in an uptrend, so in a stage 2 advancing phase, and you'd also like your stock to be in a stage 2 advancing phase as well. And that's how the screening type criteria and the trend template helps you as well. So don't worry about trying to understand everything here. There's a couple more slides.
Risk and capital protection. Think about a classic case study like Netflix. Years ago, while the rest of the market was still reeling from the global financial crisis, Netflix was doing something extraordinary. It had already made a significant move up, and every value investor on TV was calling it way too expensive. But Minervini saw the signature. He saw the VCP forming near the high. It showed 3 distinct contractions. First a 15% drop, then 10%, then a final tiny 5% tightening. The stock was holding near its highs. When it finally broke out, it was an institutional accumulation that led to an explosive multi-100% run. Mastering the pattern is only half the game. You could spot the perfect setup every time and still lose everything if you don't respect the math behind trading. Mark Minervini's real advantage isn't just chart reading, it's his relentless focus on protecting capital. He uses a strict trend template as a filter. If a stock isn't trading above its 150-day and 200-day moving averages, and if that 200-day line isn't rising for months, he ignores it completely. This simple rule cuts out most of the weak, noisy stocks and keeps his attention on true market leaders. Once he enters a trade, discipline takes over. He sets a firm stop loss, usually 7 to 8% below his entry, and never second guesses it. No hoping, no hesitation. This is because of a harsh reality. Losses hurt more than gains help. A 10% loss only needs an 11% gain to recover, but a 50% loss requires a 100% comeback. That's the trap he avoids by cutting losses quickly, preserving both capital and clarity for the next opportunity.
Here is the chart of GoDaddy Inc. from September to October 2024. The stock was in a strong trend, doubling in around a year. It then slipped into a VCP with 3 contractions. The first one was 11% deep, the second one was 6% deep, and the third was 4% deep. The stock broke out from the third contraction at $166 on this gap up day. After the breakout, it retraced a bit but did not hit the stop loss, which was placed at the low of the third contraction here at $159. The stock then rallied another 26% or $44 from the breakout point, which is 6 times the risk on the trade. Here's the chart of another stock, Royal Caribbean. This stock was also in a strong uptrend, doubling in 9 months and then slipping into the VCP. This too broke out after 3 contractions, with the first being the most violent when the price crashed 25% from the highs. However, it quickly recovered as sellers got exhausted and buyers took over. The second contraction was 9% deep, and the third was a tiny 3%. The stock then broke out with decent volumes, with an entry price of $173 and a stop loss at $167. It then rallied to $257, delivering a reward to risk 14 times in 3 months. With this type of trade, you can be wrong many times, but still end up in considerable profits in the long run.
Small losses, massive winners. Position sizing is the final pillar of this massive return. Even with his high win rate, Minervini never risks more than 1% to 2% of his total account on a single trade. If you have a $100,000 account and you're risking 1%, that means your maximum loss is $1,000. If your stop loss is $4 away from your entry price, you can only buy 250 shares. But this is exactly what allows him to survive the inevitable losing streaks that every trader faces. In fact, Minervini actually expects to lose on 60% to 70% of his trades. So how do you make millions while being wrong most of the time? It comes down to simple math. If you lose 8% on 7 trades, you're down 56%. But if your 3 winners each return 100%, you're up 300%. Net result is a massive profit. That's the edge Mark Minervini built his career on. Small losses, oversized gains. He doesn't just sit and hope when a trade works. He actively manages it using trailing stops. Once a stock moves 2 or 3 times his initial risk, he raises his stop loss to a logical support level, like a moving average or prior price structure. This locks in profit and removes emotion, allowing him to let winners run without fear. To strengthen his conviction, he also looks for the big 3: strong earnings growth, 25% plus, rising sales, and expanding profit margins. When these fundamentals align with a tight VCP in a stage 2 trend, it creates the ideal conditions for explosive, high probability moves. The lesson from Minervini's career isn't that you need a PhD or $1 million terminal. It's that you need the discipline to wait for a very specific set of criteria and the stomach to go against your own instincts. It feels safe to buy a stock that's crashed 50%, but it's actually the most dangerous thing you can do. It feels dangerous to buy a stock at a new 52-week high, but that's where the real fortunes are made. Mastery isn't about being right every time. It's about executing a proven methodology with machine-like precision over and over again until the math of the market does the heavy lifting for you. Mark Minervini proved that with a high school dropout's education and a relentless focus on risk, anyone can beat the giants. The 33,500% return isn't a miracle. It's a byproduct of a system that refuses to lose big.